This is Mastering Your Wealth with David Gagnon, the podcast.
Warren Buffett officially retired at the age of 95. Before stepping away as CEO of Berkshire Hathaway, he moved a lot of money. I'm talking a lot, $373 billion over to cash. A lot of people, they do the same thing. They retire from work and they dial back all their risk. But does pulling out of the stock market just create a different type of risk?
Yes, it absolutely can. And this is one of the biggest misunderstandings in retirement planning. When people retire, they naturally want to reduce risk, and that kind of makes sense. You no longer are earning a paycheck, so that's quite different for most people. And you may be drawing income from your investments. You do not want a major market decline derail your retirement in the first few years, and that can happen if you don't update your investment strategy to go from an accumulation phase of investing to an income distribution phase. It's all about income now when you hit your retirement years. But the danger is assuming that less stock market risk means no risk. And that's what people kind of gravitate to. They look for ways to lower their market risk, but things will creep up because you're not keeping ahead of inflation. You know, if somebody pulls entirely out of the stock market and moves too heavily into cash, such as CDs or very conservative investments, they may reduce short-term volatility, but they can create a different kind of risk. The risk that their money does not grow enough to keep up with inflation, taxes, healthcare costs, and a long retirement. So retirement planning is very challenging when you are looking at a time frame that you may need to stretch out your money that might last 15, 20, 30, 35 years like my dad. And over that length of time, inflation matters. It creeps up on you, and even modest inflation quietly reduces your purchasing power risk. So, a retiree may feel safe because the account balance is not bouncing around, but if the portfolio isn't growing, the real value of that money may be shrinking. And that's a different type of risk, loss of purchasing power. So you go from trying to mitigate market risk in your investment plan now to being exposed to inflation or loss of purchasing power risk. So, stocks have historically been the growth engine in a portfolio. That does not mean retirees should be overly aggressive, but for many retirees, owning no equities at all may be too conservative. We worked with a couple not too long ago who retired and moved everything into cash because they were afraid of market losses. And they felt safer at first, but when we ran the retirement forecast, we showed them that inflation and withdrawals could create a problem later in retirement. And a lot of times that creeps up on you, and now you created a problem because of a lack of a income distribution plan that you may not be able to fix later. They were protecting against short-term market drops, but exposing themselves to long-term purchasing power risk. And that's what they found out years down the road. So we didn't move them back into an aggressive portfolio. We created a more balanced strategy. Some money stayed liquid for near-term spending. Some was positioned for income. Some remained invested for growth. And we created a withdrawal strategy so they wouldn't have to sell growth assets at the wrong time. And that's what catches people off guard over time if they haven't aligned their investment plan with their income plan, meaning that they stayed invested too aggressively in the market. They were selling off shares when they needed a paycheck. But when the markets start losing value, you have to sell off more shares. And what happens is you start killing your goose that's laying your golden eggs slowly over time. And that's referred to as sequence of returns risk when you have poor market performance, especially early in retirement when you're relying on those dollars to create a paycheck. So that is how we help people. We identify the purpose of each dollar. Short-term money should not be exposed to unnecessary volatility. That's pretty important. Long-term money shouldn't be so conservative that it cannot fight inflation. So you have different areas of how you invest for different time frames and when you're going to need that income. And there's certain financial objectives we're trying to position that money for, because we can show folks how to create a high yield cash flow by investing in high fixed income alternative investments. So you don't have to rely on low yielding CDs or fixed annuities, things that just aren't producing enough yield so you can create a meaningful income without selling off shares. And this is where strategic income planning comes into the focus, because when you get it close to retirement, we need to design a personalized strategic income distribution plan and look at all these variables. And I don't see people working off of a plan, unfortunately, And we get calls from people who've been retired for years, and now their backs are up against the wall financially because they made these mistakes, and all these things started to transpire over time that was hurting their income plan. And when they finally saw what was happening, now they're at a stage in retirement where it's harder to fix these problems because they lost money unnecessarily because they weren't working off of a plan. Now they have less resources to create the income that they're going to need for the rest of their lives. So planning's the key.
And you mentioned here, yes, planning is the key, especially when it comes to creating a strategic income plan. If you'd like to sit down with David one-on-one and create your very own customized income plan, call right now. That's 203-872-0009, 203-872-0009. We're talking about risk tolerance and, of course, being involved in the market. And, it's really easy to stay the course when the market just keeps hitting new highs. That might make some investors a little nervous. But Market Guard Chief Investment Officer Brad Jenkins says up markets are actually the best time to make sure that you're prepared for the next downturn before it arrives.
We want to say, am I prepared when that next correction happens? I love this quote from Warren Buffett. He said, Noah built the ark before it started raining. You don't want to wait for the floodwaters to start rising. Then you're reaching for your hammer, your nails, your wood, saying, we got to build a boat. Hurry, hurry, hurry. It should already be done. All you should have to do is say, hey guys, this rain's not stopping. Why don't we get inside and close the door? And then as those floodwaters rise, you're already built and prepared for it. And so I think a big thing is we don't want people to get caught and to get caught off guard. So at Market Guard, what we really believe is we want to create this strategy that's going to enable them to get that growth they're looking for, but to already have that defense ready to go. So when that market gets nasty, they've got something and they've got a strategy and a plan that's already in place.
Okay, interesting. So what are the ways, David, that you help clients build the ark like he talks about so they're prepared when those big raindrops start to fall?
Brad's exactly right. And I've known Brad for many years, and what he's referring to is a backup strategy for when the market really goes south on you, because you want to be proactive in your planning, and that's what his Market Guard system will do. And that is exactly when preparation should happen before the storm. You want to be proactive. Now, when markets are falling, emotions are high. People feel pressure. Headlines are negative. Account values are down. That is not the ideal time to design a risk management strategy from scratch. You want it already in place. The best time to prepare for the next downturn is during a strong market, when clients have gains, you have flexibility, and the time to make thoughtful decisions in your strategy. So we help clients build that arc in several ways. First, we review the portfolio's actual risk. A lot of people don't really understand how much risk they've exposed their money to. Many people do not know how much risk they are taking in many cases. They may own mutual funds or multiple funds that overlap heavily or have more exposure to one sector than they realize. So they're not as diversified as they feel they are. And second, we rebalance. So if stocks have grown significantly, the portfolio may be more aggressive than intended. So rebalancing helps to lock in gains and bring risk back in line. But when we do our comprehensive investment portfolio analysis, we find that there's a lot of overlap in stock sectors, and there's a heavy concentration in a very few. But we also look at diversification amongst not just different asset classes, but investment strategies or investment product types that can broaden your allocation of diversification in different ways and solving a lot of different benefits that we're striving to achieve, such as consistency in return, lower volatility, more predictable income, higher yields for that income, and incorporate that with a tax-efficient withdrawal strategy. The third, we're going to build liquidity. That's very important in retirement because retirees need cash-term assets so they're not forced to sell long-term investments during downturns. And I see this happening all the time with my clients. They have an unexpected expense come up. And I had a call the other day. Somebody's car broke down, and it wasn't a very old car, but it was a car that they were going to have to invest a sizable sum into getting back on the road. But in their income plan, we had built-in contingencies for the unexpected. So we already had the right assets in place, so then it didn't compromise their income plan. So we were able to send them the cash from the right area because it was planned for. And that was very comforting to them. They thought this was going to be a big financial setback for them, but it wasn't. Fourth, when we separate income needs by time horizon, money needed sooner should be positioned differently for money needed in 10 or 15 years from now. So you have to kind of look at the future in different time frames and align those dollars for those time frames with the right investment tools for the right solutions. So it's planning, and coordinating all these moving pieces to your income plan is very important. So if you're trying to struggle through retirement and look for that paycheck and reduce that financial anxiety as to whether you have the money in the right place to create that paycheck, give us a call. Let us do that high-level review of your current income plan, and let's see where the problems might lie ahead and how we can employ better financial solutions to the process.
There you go. Finding the answers, helping build that income. And as you talked about here, this investment portfolio, it's 203-872-0009. 203-872-0009. That website, of course, masteringyourwealthradio.com. Artificial intelligence is showing up everywhere these days, including personal finance. If you need a budget, just ask AI. Wondering how much you should have in savings? Ask AI. Looking for investment ideas? Yes, ask AI. But a new study from the University of Georgia suggests investors should be careful before treating a chatbot like a financial planner. Researchers tested 7 major AI platforms and found out that while the answers often sounded reasonable, they weren't always consistent. And sometimes the recommendations varied significantly from one chatbot to the next. So let's break this down. If AI is becoming a more accepted financial tool, where does it still fall short in retirement planning?
AI can be useful, but it's not a substitute for personalized retirement planning. The biggest issue is that AI can give answers that sound confident and reasonable, but those answers may not be complete, consistent, or appropriate for the person asking the question. Retirement planning is not just about generating general information. It's about applying the right strategy to a client's specific facts. And everybody's situation is so different. So that is where AI often comes up short. AI may not know your tax return. That's a critical area of evaluation with your planning. It may not know your Social Security options. There's hundreds of claiming strategies for a married couple. And we always do, when we set up a retirement income plan, the very first analysis that we're going to complete is a Social Security optimization report. So we know exactly when each spouse should claim their Social Security benefits, so that based on what they think their life expectancy is, we can optimize their combined Social Security income benefits. And that is an area where I see very costly mistakes being made. AI may not know your pension election choices, may not understand your health situation, very critical there, family responsibilities, your debt situation, your tolerance for risk, estate planning, insurance coverage needs, or how all the moving parts interact together. That's where AI comes up short. It can be very black and white in a specific area of information, but you got to tie in that to other moving financial pieces to your plan.
Well, exactly. And it doesn't read your emotions. And this is crazy to me. I think AI is great for, again, as a resource. I don't think it's a replacement. I know there's tons of folks out there using these different apps and different chatbots to literally invest their money. They're just trusting this machine, this technology to invest their money versus somebody like you, David, with over 30 years of experience sitting down and saying, hey, these are my concerns. This is what I want. This is what I don't want. And just like the examples you give all the time, hey, so-and-so's car broke down. I got to figure out what to do. Again, it just comes down to, this is the biggest decision that you'll ever make in your life, is how are you going to plan for retirement? Who do you work with? And I just think personally that it's crazy to sit down to an AI chatbot and plan your financial future. It doesn't make sense to me.
Well, and different AI platforms can give different answers to the same financial question. So the consumer may not really know which answer to trust. And you have to kind of weed between all that information to see what really truly aligns with your personal situation. It doesn't mean AI is useless. It can be helpful for education. It can explain concepts. It can help organize questions. It can help someone understand what a Roth conversion is or how Social Security claiming works, but the final decisions need to be based on real planning. Recently, I worked with someone who had researched Roth conversions online through an online AI tool. The general answer they received was that a Roth conversion could reduce future taxes. That was true, but incomplete. So when we ran the numbers, a large conversion in that year would have pushed them into a higher tax bracket and triggered Medicare premiums at higher surcharge costs.
Right, because they were making more income. That's why.
Right. So that didn't explain the other things that could come back to hurt you in your blind spot. So what we did was we redesigned the strategy as a multi-year plan instead of a one-time conversion. And that is the difference between information and advice. Our role is to integrate that full picture, look at your investments, your income, your taxes, your Medicare, Social Security, estate planning, insurance, cash flow, debt, and your goals. I mean, AI's got to look at all of those areas of implications to your planning, and it can't. It just can't at this point. Maybe someday it'll be more robust, and it can do that. But, AI can support education, but it cannot replace the responsibility of personalized judgment and managing of emotion. So in retirement, a good sounding answer is not enough. The answer has to be right for your personal situation. AI is pretty impressive on the surface, and it's changing so fast. And we use AI in our analysis sometimes, but we don't rely on it. I have a very good friend who has a software coding company, and he has 120 employees, and he's using AI now to write code. And he's so impressed by it, but he emphasizes that it's not as accurate as you think it is. And that's why he's got his top technicians, his IT technicians, that have to evaluate what AI is delivering to him, and they're still finding a lot of errors. So, it's got a long way to go, I think, before you can totally rely on it. And I just don't think, people have to be very careful.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims-paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.